Today, market is optimistic that we have Mag 7 earnings this week, maybe a little front running. US China deal likely coming into a positive resolution. I know Scott Besant's been vocal about it. I know we've seen some comments from Trump on Truth Social and elsewhere as he kind of tacoed his way through October 10th. But here we are, all-time highs again. Interesting disconnect between the SP, actually the S&P 500, the Nasdaq, as well as the volatility index, where we had the VIX go up from about 16 to 29, and then recently dropped to today like 16. So we've had a pretty big crush in volatility. This is that recent pop up that we saw on a Thursday to Friday, and then coming back now where the VIX is down a dramatic amount. So market melt up is in full swing. Curious to get Kane's thoughts on everything. What's up, Kane? How are you, man? Happy Monday.
Happy Monday, dude. How's everything going?
Everything is going well. Hit some nice profits today on some waterfall income. Had three trades closed out for winners. Like
Nice.
90%, 91% of the credit that we pulled in. I had some winners on those. I'm playing conservative on the like the day-to-day stuff. I mean, this is just an interesting. We're like all of a sudden having this conversation. It's a low volatility environment again. I mean, 16 is not low by historical standpoints, but it's like for what the market's been giving us, 14 to
Yeah.
16 has been considered like pretty low volatility. So thoughts on, it was a huge gap over the weekend from a Friday close to a Monday open, like 0.8% higher. It's all just kind of baked in like the optimism that US China comes to terms. We've got the Fed cut this week. We've got Mag 7 earnings. And I just feel like path of least resistance is up. I don't think much is going to derail this market, Kane. What about you? What do you think?
Yeah, I mean that's definitely what it looks like. It makes me nervous though, like two
Yep.
gap ups in a row, and as
Yep.
far as we've gone up, it's hard to say that this is going to keep on running without some sort of pause or pullback.
Yeah.
So I'm super cautious about everything that I'm going into right now.
Agree. Let me ask you this. So initially, I had put this. We talked about this last week in the GAM report, but this kind of broadening pattern. I'm not loving the fact that we have two gaps right in a row, and we also have this 50-day that has not been tested.
Yep.
So, what kind of and honestly, even if the market is going to drop down to that 50-day, what I mean, we might go to 69 plus or 7,000 plus before. I have no idea, but I think the 50-day needs to get tested. I think having gaps here is giving the market something to kind of front run the optimism, and then maybe I don't know, maybe Powell's press conference on Wednesday. It's like even when you sprinkle in Jerome Powell with core PC with Mag 7 earnings, I can't imagine it's anything other than noise. I don't see necessarily the market doing that, to 6,200.
Right.
I think we just have volatility, dude. I mean, pulling back here, going higher, pulling back again, going higher, pulling back again. Like I could see this kind of how we play out maybe the end of the year is buybacks are starting in financials. We've got good earnings, most likely on the docket this week. Fed is cutting rates. We talked about the 10-year yield last week. So, I mean, I drew this broadening pattern, and clearly prices are, going through the highs. Now, that doesn't make me say that the broadening pattern is not valid, because if we quickly come back in on Tuesday, Wednesday, and fill some of these gaps, I think this pattern is still valid. If we gap fill, the midpoint of this is right back to around 6,700. I think there's pretty good support in here. If we get to 69 plus, I mean, maybe this is that melt up that everyone's talking about. Kane is like the kind of capitulation type move, 7,000 plus. All I'd say on that type of price action would be if we get to 7,000 and we all of a sudden sweep some lows, it might be sideways, but I feel like a distribution cycle is not that far around the corner from this market. Sideways
Yeah.
is okay, but distribution could certainly happen.
Yeah. Yeah. It seems like unless there's some sort of crazy news that comes out, we're probably up for the rest of the year. I mean, I know
Mm,
the last time I looked, haven't looked today yet, but last time I looked, there was a lot of positioning around the 6,800 and which we're past now, and then 7,000.
yep.
So, I mean, that does seem like that's where we're headed. Uh, if we get chop after that, then that's not a bad scenario for the market.
No, and I think traders need to realize like sideways is a direction. Sideways is something we can trade. Sideways, I mean, I have strategies. Waterfall income, for example, takes advantage of sideways with strategy two. Daily profit play takes advantage of sideways. Double ups, like you have the same type of thing as like you have trades that allow us to take advantage of either certain pinpoint prices or certain behaviors up, down, sideways that we can still generate some good income trades.
That's
Um,
right.
After last week, we had a really nice breakdown of the butterfly spread. I love going through that with you on option strat because it's kind of helped me laser focus on my double up service. And we had a nice winner last week where we took a loss of 69%, but our winner was 190%, which wasn't
Nice.
bad. And it actually offered up to I know at one point it was a 10 wide butterfly, and I think it was offering, like, I've got it in my Telegram here. I think it offered up to 550 or 570 of profit. I think we had like a 60 or $70 debit on this thing. So it offered like an 8 to 900% return if you were a man. Here it is. So the trade itself was put in for $1 debit, and it was offering 520, 590. It cash settled at 341. But anyway, if you're managing the trade, I mean, the other side we lost, I think 70 or 75 cents on the debit side. So I took the trade both ways. Um,
Okay.
the one that was, so one did a pretty good job of pinning late in the day. It was just kind of within 2 or 3 points of our center price. But anyway, I was just updating this in my Telegram, like, hey, 326, a dollar five is now worth a dollar 520. 345, a dollar five is now worth 590. But it was slippery at the end, as it can be with just pure gamma at the end of the day at the close. But it
Yep.
still settled for nice 2 to 3% winner.
Yeah.
So anyway, fun
Awesome.
stuff. I think that was a good breakdown last week. I pulled out, these are 2 week levels. I
Okay.
know we're going to talk about some gamma with you in a little bit. What are you? Well, I mean, you have SPY gamma levels. Here's my real time. This is 2 weeks out for SPX, and my stickiest level is just crazy how there's like literally nothing on the put side. Positive gamma, there's nothing on the put side. I also know that the JP Morgan collar trade every quarter has the pin price of 7,000. So we've done this for 2 quarters in a row, Kane, as we have had prices and pressures push up to those JPM collar levels that should act as resistance, but it also forces market makers and dealer flows to like hedge against that. So if
Yep.
we're going to hit 7,000, 7,000 doesn't have to be a ceiling. Like, it can be the magnet for price, and then there's hedges going into it and possibly through it, and it could also turn into support. So depending on how quickly we get there, I'm just thinking like path of least resistance is probably bullish. I'd say the animal spirits for the most part are going to remain relatively elevated into the end of the year. China is benefiting from this as well. I mean, if you take a look at HSI, I mean, China has had a nice little bounce off these lows. I mean, China's up 5+% off the lows in the last couple of weeks. U.S. markets obviously at all-time highs again. Let me ask you this: any questions on market breadth? Are you concerned with current market breadth right now, as far as like not really supporting these all-time highs?
A little bit, yeah. I mean,
Okay.
today's move, obviously, and I didn't need to double check on last Friday's move, but today's move for sure is all basic. It's all concentrated into tech, the
Mm-hmm.
semiconductors, the cloud computing. It is very, very, very concentrated. So
Yep.
I'm not like Dow Jones. It did gap up, but it hasn't moved since then. S&P has moved higher, but the Dow Jones is just kind of flat.
Yeah.
And
Yeah. Very flat.
IWM, yeah, small caps, same thing, or maybe even slightly down, small caps.
0.24, and that's a gap higher,
Okay.
but kind of so it's a red candle but a gap higher. So Dow, here's
Right.
Dow, gapped up, red candle on the day. Here's Russell, gapped up. It's pretty, I mean, it says
Pretty
0.24
flat. Yeah.
but pretty flat. And then Q's gap up
Right.
and up, and then SPY gap up and up, barely.
Yep.
I mean, it's been a quiet day overall. I mean, we've moved a whopping 17 points since the open this morning.
That's
So
right.
very quiet, but it's like, and those are challenging days. How do you, number one, how often are you zero DT trading? Just you personally, your services, do you do any zero DT?
Not much right now.
Okay. Okay. The reason I was asking is because I mean, I do zero DT every single day. And, the one thing that can be very challenging is these 0 day trades with a large gap.
Yeah.
And I'll say it that there's kind of two levels that I'm always watching. So if you can see my screen here, here's my daily profit flow indicator, and this yellow box is representing the volatility index divided by 16 because that's kind of the extreme move of from Friday's close to today's price action. We really shouldn't see prices hitting higher than this yellow box. However, the gap throws all that off. So there's two levels I want to watch, right? One is from this close to this yellow box high. That should be a pretty good probability that price doesn't want to go too much higher than that, just based on close on Friday, open and price action today. We shouldn't really go higher than that box. But if there is a backup plan, it would be this closing price and this VIX box. This is about, we'll just say 1%, because the VIX is around 16. So my rule of 16 is about a 1% move. So I'm looking at a plus or minus 1% move here, one way or the other. Now, because we open here, the safe conservative trader in me is going to go 1% from here and 1% from here. So I'm going to modify that based on these big gaps. And so sometimes that is the right trade to do, and sometimes it isn't. Like today I did this, and I went up here to do my premiums, and I'm clearly like not getting filled on anything because price has done jack squat today.
Right.
But I mean, obviously I'd rather be safe than sorry. It's like to take the aggressive stance and get my hands dirty right into the trenches of, like, if markets move like 10 or 15 points a day, I'm taking on heat on a credit spread. I went out of the way and went further out of the money, but gaps can throw us off a little bit. And that's why I was asking about zero DT, because for the most
Yeah.
part we survive, but it
What
just, I
if
mean, prices are so sensitive at zero DT.
you at the open, if you throw on the ADR instead of the ATR and arrange plus or minus ADR?
Okay. So this
No,
AD,
the second one.
average day range. Okay.
Okay, 2 points. Yeah, 2.03. So 2 points.
Go, hang on.
See where that gives you.
Sorry, my camera's in the way here. Let's go. Whoa. So where to go? Settings. Do you want to go ADR2?
No, just leave it there, 14 or 10, either one.
Okay.
But current value today is 2.03.
I see what you're saying.
Oh, actually,
So
this
you're,
is
you're
2 bar. No, that's you're on a 5 minute chart. If you go to a daily chart, then see what that ADR value is.
okay. Yeah, this seems really tight for daily. Let me go chart. Let's go daily. There
Yeah,
we go.
there you go.
Now we've got it
Okay.
ADR about
70,
70 plus.
Yeah. So if you go
Interesting.
open plus 75 or 78.
Yeah. Let me see how this compares for a second. So if I get it, that's stupid. That doesn't give me a value. That makes a lot. Like, yeah, show me the number, dude. Visibility. That's weird.
I think if you click on it like a white space, there you go. Yeah.
Oh, so it's up here. Okay. I
Yeah.
was looking at it for on the actual like vertical axis. Okay. So we got 77.37. Okay. Let me see how that compares. Let me use my VIX box. This actually, I think this is actually really good. I'm working on something, Kane. That this actually might be something I incorporate into, because I use a lot of VIX. I use a lot of average trading ranges, and it gives me some nice kind of grid levels for the day. But let me park. So this move point wise from the open, there is your 71 was like the close from Friday to today's open, and there's a kind of good way to pin the highs. I think that's pretty awesome, dude. Yeah. Okay. Well, looks like I just added one more little tool to my toolkit.
Yeah.
So,
Yeah.
because what I like to see is, so this ADR value compared to my VIX box, compared to, the ATR levels for the day, it's like I typically don't see a lot of prices day to day. If I were to, it's tougher with a gap, but if I were to center this on today's open, 60, we opened up around like 52. So I'm going to update this to a 52. So it'll go 68, 52.
Yep.
Okay.
And then
Now you will see here that prices barely moved, and prices, this is what I typically see on a day-to-day basis, is oftentimes prices will stay inside of the 50% ATRs day to day.
Yeah.
Usually it does. So, and that plus or minus, I'm just curious what this is from high to low. That's about 72 points. So that gives the market, the upside. So when you're looking at 77 ADR, you're saying that's kind of your extreme, like low to high. So would you say like your range could be like 140 points?
So that
If
would
it's
no that that'd be the intraday low to high. So you
yeah, yeah,
I mean if you start out the low, go to the high, yeah. But
low, yeah,
on a normal average day, you probably have it. So if you right where you open, you go half of it. So say 35 plus or minus the open. That would
hmm
be kind of a conservative, or actually or a little bit more aggressive because you're assuming that you split the difference. And then if you
correct.
assume that it runs, then you take the entire ADR plus or
Yep.
minus. Oh,
Yep. And then the low, like the low of the day, like the low of the day would be here. So if we had a runner day,
there you go. Yeah.
70 something points,
Yeah.
look at, but see how that, I mean, that's pretty spot on, dude. Like that
Yep.
low to my VIX box based on this opening price, like that's pretty accurate. So yeah, I see the overlap, which is good because that just gives me an extra kind of level of conviction that it's like, okay, the ADR with the VIX box, those are good calculations.
Yep.
Cool. All right. I threw that in my daily profit play workspace now. So we'll take a reference to that in the mornings. Good stuff. But typical Monday, pretty much a nothing burger day, which was fine. I just didn't get filled in the credit spreads that I wanted. Um, Again, I think because I do trade a lot of zero DT, it just kind of feels like you got to be prepared for like if the market was going to open today and then run higher, if the market was going to open today and gap fill, it's like I have to take that stuff in consideration because you never know. Like in a day-to-day basis, you never know what's going to happen. But considering we have FOMC on Wednesday, there's a lot of volatility surrounding that. Mag 7, which is Apple, Amazon, Google, Meta, Microsoft, all with earnings this week. MicroStrategy, Coinbase's earnings this week. I think I want to say there's over 1,000 companies this week. Stock Twits. Let's see how many we've got total. Pretty sure we have over 1,000 companies reporting this week, but the bulk of it's going to be what's Mag 7 doing, especially when with this concentrated earnings. Let's get a number. So we took a lot of trades last week in my newsbreakers course. We have 62 today, 157, 241, 276, and 41. So almost 800 stocks reporting this week,
Yeah.
with 6 or 7 being very important.
Yeah.
Did you get anything on Tesla last week with Tesla earnings? Did you read anything into that? It was up again today by another like 4 or 5%.
Yeah, I mean, I think Tesla is strong. It's in a wide range chop, but we had
Mm-hmm.
that target from a couple of weeks ago, about 500 out into December. So,
Nice.
I mean, it's slowly working its way there.
Yeah, I love it. This has been one I've said I think we can get to all-time highs. I mean, Apple has recently poked all-time highs today. Another one. Amazon, not quite there. Um, I would. I mean, Amazon seems pretty well supported. They have earnings this week. Um, I don't see. I mean, I have no bad reasons to not participate in Amazon. Maybe the one threat that I see is like Shopify and OpenAI. Like there,
Mm.
there are some there's like the shopping competition, but overall, like AWS had a little glitch last week. I mean, we experienced here at Prosperity Pub. But Amazon to me is like logistically still just like one of the strongest companies. They've revolutionized logistics, and I know there's competition, but I don't know, man. I like Amazon for kind of a forever stock. Give it to, I don't know, sell puts. that's my style on Amazon. Sell puts. If you own it, hang on to it. It'll be fine. Broadcom, I haven't really done much since the earnings gap here. Google, another all-time high with some juice into that. They have earnings this week. Meta, any thoughts on Meta, Microsoft? They're pretty close to getting back to all-time highs. Have you been looking at any big gamma levels on those stocks? Do you trade gamma levels with earnings like coming up this week?
I don't trade through earnings with gamma levels, but I will
Okay.
look for runs into earnings.
Okay.
I'll look for those, and it
Okay.
looks like Meta might be running a little bit into its earnings. Microsoft, I haven't taken a look at for a little while, but it was doing well, I think 2 weeks ago ish, two-ish
Yeah.
weeks ago. Yeah.
Okay. I mean, positive earnings. We probably revisit all-time highs. This is Meta. I mean, that's
Yeah.
that's not that far away. That's only about a 5.8% move. Meta average earnings. Average earnings on Meta. Microsoft, I want to say Meta's like high single digits. Yeah, 7.7. So on average, I mean, if we have a solid print, Meta has enough to get to all-time highs again. Um, I would take. I mean, if I was going to put pot odds on it, I would say that we're likely going to go higher versus lower. There's two ways I trade Meta. One is you take a cheap bull call spread that pays you. If you get more in reward than risk, that's not a bad trade to see if we just go up. Meta is on Wednesday, so you have to manage this thing Thursday and or Friday. The other one would be if we have a bull call spread here that pays more in reward than risk. That's kind of trade one. Trade two would be either this 200-day moving average support, or maybe all the way back down here to a gap fill. And I would still be buying. I'd be like bull call spread down here, bull call spread down here. So, between 1, 2, or 3 levels. This trade would be more, I put an expiration in for Friday. So the 10/31 expiration for this one. These two, I'd probably go out to the end of the year. I'd see if we can go like a 12/31 or whatever the end of the December expiration is, because those would be more like get pullbacks, get swing trades, and see if we can stabilize. So I lose on this one for a small trade, and then if we get filled, those are obviously good trades. If price is up to fresh highs again, cancel, and just ride it out, I guess. So let me see what this price is out to be. I don't really love the trade right now unless we are going to go. 5 to 7% higher. That's a 40 to 50 point move. I think this is. If it's 250 wide, that'd be a good trade versus 5 wide. But let's see what it shows here for Meta. October 31st, earnings on the 29th. That is Wednesday. 7. So we can go 47 by 50. Kane, I don't mind taking this trade, dude.
Yeah.
Right?
If you can get it for,
if I can get it for under $1.25,
yeah.
Let me try a buck. Let me try $1.20. I'll take this. I'll take a stab at it. As long as it's less than $1.25, $1.21. Even $1.25 is still a good trade. Now it's trading mid at 127. Yeah. But let's see if we get filled for $1.25. I'll take the trade. 122, 23, 24. Just got filled for $1.25. Okay.
Nice.
All right. So that trade is in. I guess officially I can put this into my Newsbreakers service. I'll make that official. So I'll go for everyone here. So you all in the Gamma Report can have the trade if you're interested. This is officially going to be a Newsbreakers trade for me. Newsbreakers, Meta, 10/31 expiration. I'm buying. That was filled. So that was a 747.50 call, and sell the 750 call for $1.25 debit. $1.25 is my max risk. 250 is my max credit, and that's $1.25 max profit. As long as Meta is greater than 750 by Friday or up above to manage partial profit, looking for 30 to 50% target or full profit by Friday close. Okay, I'm going to make that official for my Newsbreakers, and we'll take a stab at it. And like I said, if we get the dips and pullbacks, I'll just reposition and probably have an opportunity where if we get a pullback on Meta and I can get in for a similar trade, I might take a second contract. So if I win on this is what I'm talking about. So if I get a trade where for some reason this one doesn't win, if it dips and I lose, then I'll take a trade down here where if I lose this one, win this one, I'm going to be net positive. That's how I trade that second entry if I needed it. So we'll talk more about that in class, but I'm going to make this official here. Okay, Newsbreakers live trade, cool. Microsoft, similar. I don't love the little kind of island price action, but probably the same thing. Microsoft, I kind of like Meta. I think Meta is typically more volatile during earnings than Microsoft is. Here's Microsoft. Average earnings move is about 7.8%. 7.8 from here. Again, if we hit the average move, that puts us up to all-time highs. Do you like where this one is currently at? Would you want to see, you like kind of buying dips on Microsoft more? What do you like?
I would, although that is sort of a breakout from that recent high. Yep. So if you treat it as a breakout, then that's kind of okay.
Okay. Microsoft, we have earnings 29th. That's going to be Wednesday as well. 31st would be the Friday expiration. Dividends on the 20th. I wouldn't go out that far necessarily. Another one that's 250 wide, 27 by 30, $1.33. You're paying a bit more for that one. You go more at the money, $1.23. As long as price stays, where it is, then
Yeah.
you're not going to lose anything. But if it goes up a little
Right.
bit on earnings, that should be pretty good. I think the only wrench that gets thrown into earnings this week would be FOMC. I don't know if Powell like brings the pain, but you know what I'm saying? Like
Yeah.
it's just noise. But I mean, like you and I talked about last week, if the Fed's going to cut October and December, I think we really decide whether this is a good thing for the markets, a good thing for yields by probably end of December or January of 2026.
Yeah.
Because if the Fed is cutting 100 basis points here, and now we're cutting September, October, December, 75 basis points here. If this does not go lower, then I'm concerned. If this goes lower, okay, fine. I mean, what would I do with this personally? Probably refi my house. If we're down, I mean, seriously, I mean, I
Yeah.
closed here at 6.6. If we see that the actual 10-year is down to 3.6, I might be able to get a refi for, I mean, if I don't know how close it's going to be, but I could probably get a refi that's like 0.7, 0.8% better. I'm hoping.
Sure. Yeah.
That might be enough if I can, recoup the refi cost within, 6 to 12 months. Just depends on how the math works. But again, I would say I would watch that closely because my concern is that we don't go dramatically lower than that September low for some reason. And I'm not trading yields technically, but I just have a concern that somehow like bond traders are going to demand higher premiums and not just see this thing crumble. So, but a recession, yields go way lower. No recession, I think it's going to be elevated. Global PMIs are up. I think inflation is going to be sticky. So it's hard for me to believe we're going to be like sub 3.5, low threes in the 10-year yield. Um,
Yeah.
yeah.
Yeah. It's hard to see at the moment.
So anyway, chart alarms are set, but cutting in October this week, cutting in December, watching kind of end of December into January, like how is this 10-year yield going to react to these rate cuts? Because this was the big story for 2024. Fed cut 100 basis points, market did the exact opposite. This year, cutting 3 times, if we trend lower, that's a good sign. But like I said, I'm just a little leery that we don't necessarily go too much lower and it becomes like a kind of range bound trade. Do you have high hopes for 2026 as far as if we have a third year that's, I mean, if S&P stretches to like 17, 18, 19% gain for the year, would you be, super enthusiastic about, another 15, 20% 2026 in S&P, or would you be a little cautious?
I would definitely be cautious at
Yeah.
that point. And then
Yeah.
I'll be looking for once the Fed stops cutting rates, that's
Yeah.
when a lot of things can really fall apart. So
And when would that be? Maybe summer, fall. So you've got, if the Fed stops
yep.
cutting and then you've got midterms, I think second half of 2026 could be pretty rocky, man. I don't
Yeah.
know. I think 2026 is going to be a trader's year. Like if you know what you're doing and you're trading like conservative and income, I think you can do just fine. But if you're going for like, I'm all in, I'm 5x leveraged on this ETF and blah, blah, it's like, I just think direction is going to be very tough to get because we've had so much of it the last 3 years. I think it's going to be challenging to just continue to see like these ripping stocks. I want to ask you a question on this indicator. I put this in for, have you ever used on balance volume?
I have a while ago. Yes.
Okay.
Yeah.
Any case for it? Any use for it? What do you like? What would it be on in your indicator list for?
Basically, trend confirmation is
Okay.
what I would use it for. But the volume, net volume, are we getting gains in volume, or is volume going towards the buys or it going towards the sells? Right. That's the
Right.
basic idea of on balance volume.
Yep.
So what I would add to that would make it more interesting is tracking of how much is being bought on margin, right, and how much outstanding margin is there. So if
Yes.
we're getting really stretched out, which I
Yep.
think we are,
Yep.
then once you start getting margin calls in the markets, then things are just going to tumble pretty fast.
I don't disagree with that whatsoever. I mean, this is a huge red flag for me, but when I saw that they were finally issuing 5x ETFs, I'm like, what is happening right now? Like, why is that? Why
Wow.
is double and triple not enough for people. It's like a 5x. Are you kidding me? So I actually referenced this morning. I thought this did a pretty good job, even through this little rollover this year in February, March. If you can see my vertical axis here, I'll kind of chart this. So if we go to the top over here, this on balance volume was actually making a nice little decline move for this first little drop in the market. And I mean, obviously, look, if this thing rolls over, I think the one thing that does make me nervous about this market is that I don't think 20% is out of the cards at all, because there's so much leverage in the system. There's so many derivatives on top of derivatives that like 10 to 20% in these markets can be our pullbacks. We're asking for, can the market pull back 3% or 5%? And that's like a healthy correction. But the blowout type moves, like 20% has been the thing. Like happened this year, we had 20% peak to trough. 2022, we had a 25, 30% plus correction. COVID, we had a 30 plus % correction. So I mean, I don't know. I just think that traders need to realize like volatility when it comes can come fast and aggressive, and it's absolute chaos there for a little bit. You obviously hope like, oh, buy the dip. Where do I buy the dip? But anyway, I just thought that was interesting. Like this indicator's done a pretty good job of confirming that there's additional volume going into, the trend, which is up, and we've been melting up since, and this is still continuing higher. But the reason I compared this, the reason I found this weekend is I went back to, everyone's been comparing this current run to like the 1990s, right? That we had, I have some charts on here that are showing a non-bubble. So is this against the crowd, or is everyone too bubbly right now? Kane, you bubbly? Are we in a bubble?
Well, I think so, but I don't know that how close to the pop we are. So
okay. So here's some thoughts. The S&P 500 price to earnings ratio remains below peak.com levels. Okay, so peak.com, I mean, just also this was, companies that had zero revenues, valuations that were through the roof, and it was that was the bubble, and it was crazy painful to the upside, and it was crazy painful to the downside. I'm sure there were winners and losers all over the place when it was all said and done. If you survived it, you had a great time to buy a discount that had gains for 7-8 years solid, and then you have a great financial crisis right after that. So fun decade, I'd say. A fun decade to kind of have like two major resets in the markets. But everyone's talking about a bubble. And also it's been like this was just a crazy parabolic move in valuations. This has been slow and steady. And also the one thing I also think right now is we don't have debt that is fueling this CapEx spending. We have sales. So we actually have cash flow. We have sales. And yeah, I know that's by the largest companies in the world, but it's not debt that's fueling this AI boom and fueling this growth. But I do think that, like you said, when the music stops, everybody exits the dance floor. But part of it could be when the Fed stops cutting, like you said. It could also be if CapEx spending is not still persistent, and also if you see more companies that are taking out debt to try to get into this like AI chase. That does have me concerned for like future growth on some of those companies. So as long as Mag 7 keeps spending, as long as like what is the phrase right now? I think it's like large language models and AI stuff. It's like as long as tokenizing or tokenization is continuing to grow exponentially and the demand is insatiable, then I think that's also a good thing to kind of keep this AI narrative going. So here's one chart that says, okay, not necessarily a bubble. And we also know the famous saying, bulls can, the market can remain irrational longer than the traders can remain solvent. So that happens on bull markets and bear markets, mainly bull markets. Here's another one I thought was interesting. Are we in a bubble? Valuations in the dot-com bubble from then versus today. Intel, Microsoft, Oracle, Cisco. This is price to earnings ratios. Microsoft is a common denominator here. So we've got Google, NVIDIA, Apple, Microsoft. But look at Microsoft back in the dot-com bubble. 60 times price to earnings. Today it's 31.9. It's still high. Like Mag 7's like 30 times earnings, while the rest of the S&P is probably trading more like 20 to 21, but elevated, not necessarily bubbly territory. So I thought that, and then like Cisco, 100 times sales, 130 times price to earnings. Oracle, these companies got rocked during the dot-com bubble. Intel, if it wasn't for the government stake, I don't think Intel would be doing nearly as well as it is right now. So there's another chart. I thought, okay, are we in a bubble? Not necessarily. And then this one here, the largest stocks traded a valuation of roughly 29 times, which is well below the tech bubble period of 2021. So your top, like your five largest stocks, compare that to the dot-com bubble compared to now. Big difference. So even at the top of the food chain, it's not crazy over valued, I don't think. So I don't know. I just thought it was interesting to find something contrarian to like everyone talking and preaching macro bears and macro bubble. And I don't know. I mean, is it did you listen to podcasts and like check out stuff on YouTube? Because like it's exhausting to see like everyone's bearish. And it's like, is it just for clicks? Is it just for a headline? Because if you're trading bearish, good luck. I mean, I just don't get it. If you've made your money during bear markets, you've made money what, every couple of years in a 60-day window, and then after that you just get crushed the whole time, and you just swear the market's going to go down as the end of times, and it's going to be. I'm exhausted talking about it right now, and I've been talking about it for 30 seconds, let alone positioning my entire portfolio around being bearish. I mean, I listened to a podcast this weekend, and the guy was talking about like just parking everything into treasuries and walking away with risk-free. I'm like, okay, but I mean, to do what? To have? I mean, if you manage money for anybody and you're yes, risk-free, but a risk-free what? Risk-free 3.5%? Like,
right.
I mean, people can literally do that on their own. Why would they pay it? Why would they pay a portfolio manager to park money in a money market instrument for 3%?
Yeah.
I just don't get it, man. So anyway, traders trade. It's crazy how, bearish things are. I want to bring this up as well. We've mentioned this before. You brought this to my attention, a couple months ago, was the NAAIM. This is actually starting to uptick a little bit, which I think is something to watch. If this gets into the high 90s, that might coincide with a little bit of a dip in the market. So that's one thing I want to keep an track on. This prints every Thursday, right? Every Thursday?
That's right. Well, Wednesday, but we don't see it till Thursday.
Okay, so look for this on Thursdays. If this is in the high 90s, maybe a little bit of a dip or correction. Also, one thing that was a surprise last week to me is that the bears aren't going away. AAII sentiment, bears are just like persistent. There's still a decent amount. Like we're right at the historical averages of the bull market. We have had a pretty big drop in the neutral camp, but it's still, those bears are still quite high. And I don't know. I mean, obviously, I don't know who makes up all the sentiment, but we're trading at all-time highs. And if you know this, like markets that keep going momentum, all-time highs. It's not that hard for the market when it's sitting at all-time highs to still go to all-time highs. And to see this trade, like all I keep thinking about with this chart every single week is if the bear side is up over 40%, I still think that the pain trade is up.
Yeah.
Up. Like upside risk is way more dangerous because everyone is so worried about a recession. The market just doesn't reward that. The market doesn't reward when everyone's camped on like hedge your portfolio, go to cash, blah, blah. The market doesn't reward that. This is going to make everyone feel like idiots when the market is up another 5% from here. The market finishes over 20% for the year after a 20% correction and the market's up 40+%, off the bottoms. But it's just going to make people feel worse about like, how did I not participate? How did I not get anything for this year other than, I'm back to where I started. I mean, I'm curious what the let's go Barclay Hedge Fund Index, because I feel like they're probably performing at a whopping like 6 to 8% gains if you're lucky. It's like 3,000 hedge funds in the world, and 2,500 hedge funds year to date 10.61. I mean, that's better than I thought, to be honest. I feel like they considering that most people are underweight equities. At least it's been a big enough melt up. Who knows? But I still wonder if they're underweight and they're going to chase and they're going to possibly drive this thing higher. But look, the index alone is up over this. So I mean, I guess to this credit, like okay, so the average hedge fund index here, like down in a pretty rough stretch. I mean, the market had a trough of 20%, like peak to trough, and you're looking at maybe a 2% drawdown here. That's not too bad. Obviously, the upside participation is a little lackluster, but still, 10.6% upside with a drawdown of less than 2%. That's not terrible for the hedge fund index.
Yeah. We've got a couple questions coming in over here.
Let's get them.
Yeah. So first, the most recent one was from Venkat. He says, "What would the impact on the market be if the government were to fail?" What do you mean by fail, Venkat? What's the definition of fail for you? So we'll wait for him to answer.
Is the government were to fall, like as in like we just don't reopen? I don't think that's gonna. I mean,
Yeah.
That I don't think it's going to happen. Like U.S. government's going to exist in some way, shape, or form. I'm sure it's probably easier right now to be not worrying about the news. I mean, Kane, we had CPI news for the first time in 3 weeks. Like, I don't think the market would have cared whether it was positive or negative because it
Right.
was a month old. Like, we haven't had any news since ADP numbers that came out like in September. So we had this huge blackout window with like little to no data because the shutdown started on the 1st of October. So we essentially went an entire month with no data. And even the inflation was, not high. It was just like, yeah, it's warm, but it wasn't like a scary number. And
Right.
markets went higher. So make or shake. I mean, you're talking about things that probably won't come into effect until probably 2026. I think it's going to be like midterm elections are going to matter. I mean, if Trump, if the Republicans lose House and Senate and it's a big midterm swing back the other way, then it changes a lot of things in this current administration. I don't know what the deal is with the Supreme Court if they're going to actually vote on the tariff, like the way that we rolled out tariffs. If it is unconstitutional to tax a world like this, if it's considered a tax, it's got to go through Congress, and I mean, they could basically appeal what we've done for executive orders. But all that policy disruption, I don't think happens until either one, Supreme Court jumps in right now, which I said this, it's like we're kind of stacked on the Supreme Court conservative. So I don't know why they necessarily go against Trump at this point. Midterms, it's like if citizens want to step up and vote, I still think the integrity of the election is going to be in question. Unfortunately, I feel like we're at that stage of our political cycles where people are going to, like I can go cast my vote and hope it's for the best and hope it's trustworthy and hope we have a good democratic system. But I promise you, there's going to be so much noise around the midterms that there's going to be voter fraud. There's going to be integrity of the voting and how it all got there. It's going to be just a whole freaking circus. And I've heard somebody refer to all this stuff as kabuki theater. So I think it's a lot of noise. If citizens vote, great. Let's see where the chips fall. But I just think there's going to be a lot of noise around it. Trump's been one type of candidate that doesn't believe other than what he wants to believe. So if all of a sudden midterms votes are like Democrat, 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 it could be, drag things out, get recounts, say that there's voter fraud, and who knows? It's not a political statement I'm making. I'm just saying, like, I do expect there to be lots and lots of questions and questioning like the integrity of our voting process, which I don't love. I think that is basically discouraging people from voting. So anyway, well, that's not until like fall of 2026. So I'm not
Right.
sure what you mean by shaking up the cabinet. It's like, are people leaving? I don't think so. It's like it's been surprising, like the kind of spinelessness that most DC has shown. I mean,
Yep.
nobody gets in front of Trump, and nobody stands against him. It's like the only guy that's being vocal about him is Gavin Newsom, from what I can see, and he's just trolling him online. It's like, yeah, it's California, but I would never want to live. You're in California, Kane?
Oh yeah,
I'm
California.
sorry,
Yeah.
dude. I would never want to live in California. I never would.
Yeah.
Anyway, it's a huge economy, but I don't know. I feel like I've watched people, like good friends of mine that have businesses in California, and they just like year after year, it's like this from the city, this from the state, this from the county, this from the state, this from the nation. It's like it just seems like it's not really an entrepreneur's state to live in. I think they have great weather,
It's
they have
not.
awesome
No.
awesome destinations, but man, I think if you're just a business owner, it'd be so frustrating to be just like taxed and just seeing cost increasing by no real reason other than like, yeah, it's something new. It's something new that is now hitting your ledger.
Yep.
So anyway, this is
What
why
about
Max Payne tool would be awesome. Kane, I see that there from Jason. You see that Max Payne tool?
Oh yeah. Mm-hmm.
Okay.
Good. That's a actually Max Payne is already in the GEX trade terminal if you look things up on an individual basis. So if you go in and throw in SPY right now, you can see where the Max Payne is. Right. So if you
You
want
want
to
to show
look
that,
up
Kane?
individual tickers, sure. Yeah.
Yeah, show it, dude.
Get that open. All right. So, I lost my zoom. All right, here we go. Okay. Yeah. So this is SPY right now. You pull that up, and then you've got that pink level right there, Max Payne at 669. So basically what it says is if we go to 669, and this is better used with an expiration, not on all expirations right now, but basically a lot of positions would feel a lot of pain if we went to 669 right now. Let's go specifically to the end of this week. Uh, oops. There we go. And we'd see if it's up or down. It's probably going to be down because there's a lot of calls in the market right now. So yeah, 662. If we close at 662, then there's going to be a whole bunch of call buyers who lost a lot of money at 662.
Yeah.
Yeah, we'll
I
get
could
there.
see. I mean, Wednesday. Let's actually look and see. Well, let's see what like Fridays. You got SPY up, right?
Yep.
Okay. Let me see what the plus or minus is for Friday. So Friday SPY, I'm showing like $7.86. So right now SPY is at 684. So 684 minus 786. You've got a downside around 676. That's not enough to really test that pain threshold.
Right.
And
Yeah.
then 786 plus the current 684. So we can go up, 690 to 691 on the upside, downside, 670, 677. But yeah, I mean,
Yeah.
that'd be a big drop, dude. What would be
We've got
662?
690. Six
What was that max pain price? 662?
yeah, 662. That's right.
Okay. That is I mean, that's a 3.2% sell off.
Yeah.
That'd be noticeable. Like we had a what 2.6, 2.7% drop on October 10th. It'd have to be like one of those type of days. Or obviously the market just rolls hard after FOMC. I don't know. I don't see Mag 7 like puking this week. Fed maybe depending on what Powell's message is because inflation did print a little bit warmer. But what we don't have is it's like the Fed is not going to give us anything outside of maybe month to month, unfortunately. If you think the Fed's going to give us any information that's 6 months to 12 months out, they're not because, I mean, if they're data dependent, we're relying on PCE, which is this week. We're relying on CPI month to month, and we haven't had employment numbers since ADP. That was before the shutdown. So I don't know what the Fed's going to go off of that's going to give us any foresight. I think it's going to be the same vanilla message that Powell says. They're cutting rates based on a softer labor market. I also heard something pretty interesting this weekend. I've been saying this phrase, low fire, low hire. That's kind of our labor market,
Mhm.
but it's kind of it's like a net zero. Like it's a zero sum labor market because we've had, I think some of the third party job trackers have shown like 5 million jobs in and 5 million quits or something like that. There's something where like everyone that's leaving the market is still getting hired, but it's just net. It's like we're not having net growth on the job numbers right now. Whenever we do get a non-farm payroll, I have a feeling it's going to be like less than 100K. We're probably not going to have a non-farm print that's going to be over 100K for a while. I think we're probably talking if we get positive numbers on non-farm, I think like a 20K to 50K is probably the standard that we'd be expecting. I don't even know when our next non-farm is. It should be the first Friday in November. But I don't know. I mean, we're now 26, 27 days in the shutdown. I haven't heard
Yeah.
about any deadline that they're coming back online. There's now people that have gone through a payroll cycle that haven't gotten paid. So again, if this was a government shutdown this time of year, 2026, when there's midterm elections, I think it matters. But Kane, part of me thinks in 12 months nobody's going to remember this. Nobody's going to remember the
Yeah.
shutdown in 2025.
Yeah. Unfortunately, and the last one, though, I think the longest ever was around 30 days. So we're brushing up right up on that.
Yeah,
That was back in, I don't even remember the exact year,
that
but
was Trump. I thought that was Trump's first term, like 2018,
I thought hit
wasn't
that
it?
one was like 19 days. I think
Okay,
there was one. Yeah. Let me see. Let me see if AI has that
yeah.
longest.
Look it up. I know. I think we had two shutdowns in 2018 under Trump. I thought he had the one that was over 30 days, but we had one with Clinton on a couple of occasions. We had one with Obama. We had one with Carter and Reagan. I think they all had shutdowns.
Yeah. 96, 21 days, 78, 18 days, 16 days in 2013.
That was Obama.
And
Okay.
yeah, that was Obama. And
I thought
then
we had two in 2018 that were pretty close together.
yeah, we did. I'm on Wikipedia now.
Okay.
See. Okay, let's see.
And by the way, the average performance of the stock market during government shutdowns is positive. So, I mean,
Yeah.
we're up, a couple of percent since the shutdown started. I mean, October, it's like the market doesn't know what down is anymore. So,
You're right. 35 was 2018, 2019. That
Okay.
was Donald Trump.
Got it.
Oh, there we go. Huh? Maybe he's going to break his own
Let's,
record.
I was going to say, let's set the record and Trump, you've got two of the greatest shutdowns that we've ever had in this country.
Uh,
Okay.
yeah, he's already got that record.
Okay. So I mean, we're month to date up 3% for October right now with today's price action.
No,
Gosh, dude. I
that's
mean, this chart I mean, just looking at a monthly chart this year is absolutely crazy. With May's recovery, I mean, April's giant wick, May, June, July, August, September, October. Wow. Um, it's just such an impressive reflexive rally that I think now we truly do have to embrace that conversation, which is markets can remain, you don't have to call this rational, but it's like this rally can remain in check and still well supported longer than people think.
yeah,
And that's what I'm saying. Like, it is exhausting to be a bear watching prices melt up week after week and month after month. It is.
it
So
is. Yeah,
I just don't. I mean, and I saw somebody put in here, waterfall, you'll be fine. That's what Sean said. I
yeah,
agree. Like, we can be cautiously bullish and still trade and win like 98, 99% of our trades, which is what we do in waterfall income. So anyway, but that melt up is crazy, isn't it?
it is. It is.
Yeah.
What do you think of gold right now? What do you think it?
I'm actually stoked that it's coming back. I've been looking to position for pullbacks. So what I've done is this. Number one, I'm happy I took some profit. Number two, I'm happy that price didn't continue to rip through like 5,000 without me. So the fact that we pulled back a little bit, I mean, gold from the peak is down about 8, almost 9%. So what I'm doing is this. I have tickers CEF, PHYS, GLD, and SLV. Those are all gold and silver related trades that are, either priced to some derivative of the bullion or priced to the spot price. And CEF and PHYS don't have options, but I'm dollar cost averaged into them because they're pretty cheap. And I'm just going to basically keep like an investment. So what I've been doing is I had all of my, what moving average do you have in your chart there, Kane?
Which one are you looking
Like
at?
that's gold. So that's all fine. So look at okay, so I'm just looking at what are your values in the moving averages.
Oh, okay. Yeah. So I got 200, 150, 90, 50, EMA 20, EMA 8.
Okay. So I'll use Kane's moving averages. I have one position for $1,000 at the 21 period moving average. It just got filled today. Okay. I have another $1,000 at the next moving average and another $1,000 at the next moving average. So basically from the 21 period all the way down to a 200 period, I've got 4 entries with my moving averages. And the only reason I'm doing that is because I want another chunk allocated to gold and silver that I can let run for price appreciation. I do think that give gold, give silver another, 3 to 5 years, maybe another 10 years. I think we'll double. I think that going from 4,000 spot price going to 10 is not unreasonable. I think that this year, a lot of the narrative, a lot of the, I don't know, like the new, we haven't. When was Bretton Woods? Like 1971. We broke off the gold standard with Nixon.
Yeah.
Does that sound right?
70. Yeah, right. It's within 2 years of that. Yeah.
Okay.
I,
So
I don't know the exact year. Yeah.
if we're getting back to that in some capacity, like, I mean, there are certainly countries out there that are making big strides to accumulate, hoard, buy as much physical gold as they can.
Yeah.
I do think that is a play that is this, ticking time bomb that is like the fiat system. The one thing that does make me nervous about the fiat system and the US at $38 trillion in debt is that if we try to add crazy amounts of fiscal stimulus and we blow out our deficits, it's going to be, I think that's going to be like, kind of I don't know, the end game, if you will, or at least the reset. I think it's not an end game. It's like, we're going to have some type of like financial reset, and it could be fiat. It could be, the dollar as world reserve. It could be bonds as world. I don't know. It's something where it's like, it's going to matter at some point. But to me, I think this year with the surge that gold and silver has had, I like both of them as like now a percentage allocation. So I dumped all my TLT earlier this year. I had a nice winner on TLT when I was doing like, basically a deep in the money call from like 65. I got out at 90. So I turned like a debit of like $11 into like a $23, $24 credit. I was pretty happy with that. But I think that bonds are kind of the melting ice cube. I think that having gold and silver in the portfolio to me is a little bit better. If you're a little bit more risk oriented, I'd say add some Bitcoin to that as well. But those to me are like speculative plays, but it's also like it's a play against printing money. It's a play against the fiat, Ponzi scheme. It's and again, whether it's right or wrong, I don't know, because where I could be dead wrong in this entire thing, Kane, is like, is the dollar. So let's take gold, for example. Do you think that the dollar is going to continue to be in a bearish market? Do you think the dollar's like a secular bear market? Or if you look at the dollar big enough on DXY, like use like a monthly time frame, go back to like 1970 on the dollar index. Do you think we actually have like we're literally trading at a 50-year average, by the way? Like the dollar's been up and it's been down, but we're like in the midpoint of a 50-year average. So I'm curious, like just taking a glance at that chart, Kane, like what do you see on the dollar? Uptrend or downtrend?
It looks a little bit like chop, but
Yeah.
overall, I mean, currently, if you look at let's remove the moving averages because I don't want that influencing. Support right now, right at
Okay.
support. So if it breaks, then you go lower, and then But the other thing though is since 1970 till now, I guess this is when we went pretty close to when we went off the gold standard.
Correct. Yeah.
So that we saw that initial drop and then a run up over here in the 80s. All right. So that was, I mean, there was tons of inflation going on at that point in time.
That's crazy. I was going to say that's got to be like hyperinflation for the dollar to get that
Yeah.
strong.
Yeah.
Yeah.
Right.
Yeah.
Yeah. And then the sell off over there, and then we're kind of at the mid. So I think we are at a pretty critical point right here. We'll
Yeah.
see if that dollar starts to weaken. I mean, if we make the argument that the world is starting to move away from the U.S. and the U.S. as a reserve currency, which we're starting to see, like some transactions in oil, for example, are being transacted in the Chinese yuan and gold. So, and I don't know if you guys remember, and I don't know if this is still kind of controversial or political, but in the 90s, late 90s, I don't know if you remember Gaddafi.
Yeah.
Yeah, basically Gaddafi started saying, "Hey, I'm going to price my oil in gold," and he got killed.
Yeah.
Whether or not how he got killed or whatever, but he got killed. So now that the fact that countries can just go, "Hey, I'm just going to sell some of this stuff in yuan and some of this stuff in gold," and no one blinks about it. That says a lot to me. How the political landscape has changed.
Well, I mean, do you think that nobody I think the U.S. cares. I mean, I don't think the U.S. is ignoring the idea that countries are making moves that are like, let's price everything in gold, let's price everything in non-U.S. But at the same time, foreign investors continue to pile into treasuries. I just think there's some mixed narratives going on out there. The reason I brought up the dollar index is I thought it was a really crowded trade. The dollar had one of the worst starts in like 40 years. It was down 9%. It was crazy bearish. It became really crowded. I was long the dollar after we finally kind of troughed out. A really good trade in the short term in currencies was when the FOMC hit that bottom in September. That was a really good, and it was short term, but it was a really good like short term pop on the dollar. So what I'm saying is I think the crowded trade is still bearish dollar, pile into gold. This might be like a surprising move to the upside. I have no idea. Like, I think if the dollar breaks fresh lows, we resume the downtrend. And I wouldn't want to fight that. But if we clear, I'd say, Kane, if we clear like 102,
Yep.
I think this dollar has room
that
to
spot too.
run. Yeah, like if we clear 102 with some conviction, I think the dollar runs back to like 106, 107, 108. And that becomes like you basically just have a huge short squeeze on the dollar because everyone has been, bearish and crowded.
Yeah, and that would be a pain trade for I mean, you're starting to see in the news articles being written about the debasement trade.
Yes.
And once that hits the public eye, it's probably kind of over towards the last legs of it. So that would be an argument for this dollar ripping up as well.
Yeah, I thought there was a interesting term. So everyone's been using debasement. It's become kind of mainstream media the last few weeks. I saw somebody put out a piece and they called it the rebasement trade.
Okay.
Just because, like, I mean, all this stuff was this all happened back in like the 70s and 80s. It's so like debasement. It just depends on what your definition of debasement is. It's like, yes, purchasing power. We are losing purchasing power in the dollar, but the offset is as you're losing purchasing power, our assets like the S&P 500, or I mean, what we've seen with assets everywhere, like house prices have gone up. Everything we pay for is more expensive. Like if you're an asset owner, you have actually done very, very well through this, loss of purchasing power window. Gold, I mean, look, if people have been celebrating their gold and silver returns this year, I just want you to go back and give a lot of grace to the people that have been hardcore gold and silver owners for the last 10 or 20 years because they haven't made shit in their
Yeah.
gold and silver investments in the last decades.
Yep.
So it's nice to see a runner, but it's like it doesn't always happen like this. It's not just gold to the moon, silver to the moon. Now it's like the hottest thing ever to jump in and trade it. Look, gold can go up this year 50% and it can go nowhere for the next several years. It can pull back, 30 or 40 of that 50%. So I'm just saying, like, it's still a trade. And to me, it's a way to either allocate, it's a way to look at the charts technically, but I do think it's important that I have an allocation to it. I've decided that for my, managed accounts, I'd like to have somewhere between probably 20%. I'd like to allocate about 20% between gold and silver. And then I'm
Yeah.
debating on either 5 or 10% with Bitcoin, but I'm erring on like the 5% just because there's plenty of alpha. If Bitcoin rips and gold is up and silver's up, there's plenty of gains there. But I just think that there's lots of ways to trade, the U.S. markets and trade indexes, control some volatility. But I do think if we're having this conversation in 5 or 10 years from now, I wouldn't be surprised if gold is $10,000 an ounce and silver is several hundred. But I've kind of adopted this phrase where gold, if you give it time, is going to be considered unaffordium, and silver is going to be unobtainium. So that's what that I mean, and that's like the hardcore like physical gold exchanges
Right.
and like futures contracts right now. It's like people are wanting physical delivery, which hasn't happened for a long time. There's a lot
Yeah.
more of that going on, which is I think also a concern because it proves the scarcity.
Yeah.
So anyway,
Absolutely.
also it's
And if
just
you
a
look
trade
at
at the end of
this
the day.
this DXY, I mean, what was this down move? It was pretty hard and sharp, and it started right at the beginning of 2025.
Yep.
Basically, Trump coming in and starting to threaten tariffs is what did this.
Yep.
And then we've got a chop sideways, which is what we're in right now. And then we've got the Supreme Court coming up, and if they for even a little bit say, oh, Trump can't do this, or he's got to take back even some of it, then
Yeah.
that's an argument that this is going to start going back up.
Yeah. If that were to happen, how do you see the stock market responding to that as well?
Uh,
Positive, negative?
that's a good question. So, I mean, presumably tariffs are supposed to be bad for the stock market. So if we
Right.
get rid of them, it should be better. But it's hard.
Right.
It's hard to think that anything can make the market even better than it is right now. So maybe
Yeah.
another thing
Yeah.
that just kind of it's just whatever, and we just shrug it off.
That would be crazy to me to shrug that off.
Uh,
Just because the market, it took tariffs. And I mean, our Liberation Day peak to trough, it's like Mag 7 rotation into systemic trade war. All that stuff happened in 2 months, right? From
yep.
March to April, that was all that getting priced in. And then the market overshot it. And then we had the pivot. And then it's been the taco trade ever since. But yeah, I mean, I guess the market could shrug it off because all it would really do is I don't think it's an immediate thing by the Supreme Court. I feel like there's going to be a grace period, which is like, okay, look, you have until this time to either
Right.
pass this through Congress or figure out how to get, whatever. I mean, basically, we're operating right now with like, let's say, $1+ trillion in like a trade deficit. And with tariffs, we're getting like $300 billion. So we're still operating at a heavy deficit, period. But we're at least pulling in some revenue from tariffs. So if all of a sudden we're being told, hey, that $300 billion in tariff revenue is going away, I mean, okay, so we're still spending money. We're still at a huge deficit. It just gets wider. So then what? Do we lean on like the Genius Act and we force like synthetic treasury purchases because we're doing stable coins? I have no idea. Like, there's going to be some type of creative spin on it. I'm sure that the Trump administration is already thinking. I would hope they're already thinking ahead to it, and not like, well, they can't cut our tariffs. It's like they can because if they deem it to be a tax, you actually have to pass that through Congress.
Yeah.
But yeah, it'd be interesting if the market just shrugs it off, like, oh, this is a good thing. Tariffs don't matter anymore. But I think it matters to the dollar, and I still think that the dollar, if the DXY catches a strong bid to the upside, I feel like that's got to weigh in the stock market a little bit.
Oh yeah. Yeah. No.
So, okay, man. What else we got going on today? I want you to talk about some. What do we do? Are we doing? We're doing your Gamma Pro, yeah, today.
Yeah. Yeah.
Okay. I'm ready. I'm ready to fire that up if you want to. Lost trust is hard to recover. I'm just going to get some comments here. This is my definition of basement trade. 2014, 24 ounces of gold, but yeah, I know. I mean, look at it this way. If you want to think about having these hard assets in your life, in your portfolio, is if I had a bar of gold, like think about this. If you can have something like a bar of gold or bar of silver and it can maintain purchasing power, that is a good thing. Like I think one thing that's backwards right now in our ethos is that savers are being crushed. Like if you don't want to play in the stock market, you're getting left behind because
Oh
of
yeah.
your loss of purchasing power. But if you wanted to save money, you shouldn't be punished for that. And I feel like that is one thing that would be great to have, like a gold, like a silver, like a store of value that actually does appreciate and maintain some type of purchasing power that's going to be preserved. So whether it happens or not, it's tough. I mean, but I know that if you price a house in gold from 5 years ago to today, it takes less gold to buy that same house. But if it's
Yep.
in dollar terms, it's doubled. I mean, what
Mhm.
I see this morning, insurance premiums are up like 300% in the last 5 years. House prices are up like anywhere between 50 to 100% the last 5 years. Purchasing power is down like 20%. Inflation's up 25, 30% for the last 4 or 5 years. Like that's what everybody feels. But yeah, if you had some gold in 2025, it like helped. I mean, Kane, I had gold in my portfolio. Like it helped me generate some alpha this year.
Yeah. Hmm.
It outperformed the indexes for crying out loud.
It did.
So
I'm just that's what I just pulled up. SPY GLD right here. You can see
yeah,
it's
yeah,
not doing great.
yeah. So anyway, I mean, it's a very real thing. But like I'm saying, it's just like this backwards, like we're punishing savers. I mean, and I'll throw some statistics out there. So the baby boomers upon retirement will be the wealthiest generation ever in our country. I think it's something like $80 trillion in assets coming from the baby boomers.
Hmm.
Now there will be spending because, as they say, you can't take it with you. So as baby boomers are retiring, they will be spending money on vacation, spending money on services. Like they are the wealthiest generation to possibly keep the services side elevated, to keep the consumer side elevated. I still think there is a surprising amount of resiliency into the top percentages of spenders, like your top 20%, because the wealthiest people have plenty of assets to spend, and they're still like leveraging those assets. But it's just I wouldn't like since 2020, since 2018, since 2008. If you've been in the market for 20, 30 years and you've persistently stayed in the markets, you have made money. You have made lots and lots of money. And if you are on the verge of retirement or you are retired, I'm hoping you have enough assets where you've got enough to live. Your house number one is paid for. Maybe house number two or three is paid for. There's passive income there. There's ways to leverage your assets. But I think consumers are still going to spend, whether you give it to your family and you pass it in through donations or inheritance, or you spend it because it's time to go out and live that retirement life you've always wanted to live, and that's why you work so hard to get where you're at. So I don't know, man. I mean, I just think it's so easy to jump on the camp of either like so bearish and so bullish, but there's an in between. Like there's a reality that somewhere like everything falls in between. You've got to have some perspective on this market.
Yeah. Yeah.
So
There's always a neutral. It's kind of
yeah,
like, we tend to think positive, negative, up, down. We
yeah,
always forget about the middle case, like the neutral.
yeah.
And yeah, and we're a little out of balance at the moment. So
Okay, so let's talk some gamma, dude.
yeah. All right. Well, let's do it.
Okay.
Okay. Do you want to you're gonna drive or
I can drive. Yeah, that's fine.
yeah.
So let me grab the screen here. Um, let's see. I think if you exit out, I should be able to grab it.
Yep, there you
All
go.
right, cool. Let's try this. All right. Kane, how long has this tool been running for you?
Oh, we launched it last month, right? In the
Okay.
beginning of last month. Yeah.
Okay.
So about
Good.
yeah, a little over a month.
Okay. So, and I've seen like the guts and the backbone of this of what we're about to see here, and Kane put together something really really special. So, I know you've probably heard of it, but I wanted to be able to bring it in here to the Gamma Report. Um, I think what Kane has built is really is fantastic, and I'm pulling a lot of logic from it where, I've been able to, like I said, kind of watch in the background for months now. And I'm just seeing that it's making like trading decisions, really informed, high probability trading decisions, is making it really easy for traders, which is great. So we develop tools and strategies to the best of our ability As always, we don't have a crystal ball. We can't guarantee the future. There's always a risk of loss in trading. Past performance is not indicative of future results. What you'll see today are some of the best examples over the public trade research services that utilize the underlying method from January 2024. So that's it's almost 2 years now. Through September 2025, win rate is 78% with a 69% average winner and a 30% average net return on winners and losers. Those numbers, by the way, are actually fantastic. Over a 9-day average hold, which is not super long, that's great. There are big winners, there will be small winners, and there will be some losses along the way. So, of course, trade at your own risk. See your terms, conditions, disclaimers, things like that on our Trading Hub homepage for more information. As always, we say this almost every webinar, there's going to be losers. There's no black box miracle system that prints out winning trades. The whole purpose of Kane's research and working with traders, just like all of you folks out there, is to help give you an edge in the markets.